When I first moved to the United States, I kept hearing about this mysterious thing called a credit score. It honestly felt like some kind of secret number that everyone had, but nobody could really explain. And I figured out pretty fast that it wasn't just a number. It was like a key that could either open or lock doors to, well, almost everything. It was a little bit overwhelming, to be honest. So that's exactly what we're going to break down today. What is this powerful three-digit number? How on earth does it get to decide if you can rent an apartment, buy a car, or even get certain jobs? It really does feel like this invisible force running your life. But I promise you, by the end of this, you'll see exactly how it works. And more importantly, you'll see how you, yes, you, are the one in control. Okay, let's dive in. We're going to go on a little journey together through 5 simple parts. We'll start with what this number even is. Then we'll peek behind the curtain at the secret ingredients that make it up. We'll see why it matters so much in the real world, learn a step-by-step plan to build a great score, and then we'll wrap it all up by seeing how you hold all the power. Let's get to it. All right, Section 1. Let's start at the very, very beginning with the most basic question there is. What in the world is a credit score? Let's think about it in the simplest way we possibly can. A credit score is just a number. That's it. It's a number that tells companies how good you are at borrowing money and paying it back. It really is that simple. Think of it like a report card for how you handle your money. If you borrow some money, let's say on a credit card, and you pay it back when you promised you would, you get a good grade. If you don't, well, you get a bad grade. This number is your financial grade. And these grades or scores, they usually go from a low of 300 all the way up to a perfect 850. Just like in school, a higher number is way better. An 850 is a perfect A++, while a 300 is, well, it's kind of like a failing grade. This single number quickly tells a lender, someone who's thinking about letting you borrow money, how likely it is you'll actually pay them back. So who are the teachers giving out these grades? There are 3 big companies called credit bureaus: Equifax, Experian, and TransUnion. Think of them as the official scorekeepers. They watch all of your borrowing, every credit card, every loan, every single payment you make, and they use all of that information to calculate your score. Okay, now let's look at what these numbers actually mean in the real world. If your score is up there between 800 and 850, you're exceptional. You are the star student, lenders absolutely love you and will offer you their very best deals. In the 740 to 799 range, you're very good, a super low-risk borrower who gets great deals. A good score, from 670 to 739, that's where most people are. You'll get approved for most things with pretty decent terms. But if you fall into the fair or poor range, that's where things get tough. You're seen as a much bigger risk, so you'll pay a lot more to borrow money, if you even get approved at all. So how in the world do these companies come up with your grade? It's not random at all. It's actually based on a recipe, like a formula. The most common recipe is called the FICO score. So let's look at the 5 secret ingredients that go into that recipe. And this shows you so clearly what matters most. See how the recipe isn't balanced? It is dominated by 2 main ingredients. They make up almost the entire score. The biggest piece of the pie is your payment history. That's 35%. Basically, did you pay your bills on time? The next biggest is amounts owed at 30%. How much money do you currently owe? The other 3, how long you've had credit, the different types you have, and any new credit you've applied for. They're much, much smaller pieces. Let's talk about that biggest piece, payment history. This is, without a doubt, the most important ingredient in your score, by far. And it's so simple. Do you pay your bills on time? Every time you pay your credit card bill, your car loan, or your mortgage on time, you're helping your score. But if you're late, especially more than 30 days late, it can really, really hurt your score. So the biggest takeaway is this. If you only do one thing, make it this one. Always, always, always pay your bills on time. Okay, on to the second biggest ingredient, how much money you owe. But it's actually a little more specific than just that. It's about how much you owe compared to how much you could borrow. This has a fancy-sounding name, your credit utilization ratio. But don't worry, the idea is super simple. I want you to imagine your total credit limit is a big glass of water. If you have a credit card with a $1,000 limit, that's your full glass. Now, lenders get pretty nervous when they see your glass is almost full. A balance of $900 means your glass is 90% full. That looks risky. They much prefer to see your glass mostly empty. A balance of $100 is only 10% utilization. That looks great. The general rule is to try and keep your usage below 30% of your limit. But honestly, the lower, the better. Now, let's quickly touch on the last three smaller ingredients. At 15%, we have the length of your credit history. Lenders just like to see a long track record of you being responsible, so the older your credit accounts are, the better. This is why you should never be in a hurry to close your oldest credit card. Then, credit mix and new credit are each worth 10%. Having a mix of different kinds of credit, like a credit card and a car loan, shows you can handle different types of debt. And finally, applying for a bunch of new credit all at once can make you look a little desperate, so that can temporarily dip your score. Okay, so now we know what a credit score is and how it's made, but why does it matter so much? Let's get into the real-world impact. This is where that three-digit number stops being just a grade and starts affecting your everyday life and, maybe most importantly, your wallet. A good credit score is like a master key. Seriously. Want to rent an apartment? The landlord is definitely going to check your score to see if you're likely to pay rent on time. Buying a car or a house? Your score determines if you even get the loan and how much extra it's going to cost you. It also affects credit card approvals, how much you pay for car insurance, setting up utilities like electricity or your cell phone, and even passing background checks for certain jobs. It truly touches almost every major financial part of your life. Let me show you a really powerful, real-life example of how this works. Imagine two people, person A and person B. They both walk into a dealership and want to buy the exact same car for $30,000. Person A has a poor credit score of 590, and the bank offers them a loan with a 12% interest rate. Ouch. Person B has a very good score of 750, and they get offered a great rate of just 4%. Same car, same price, but a completely different deal. So what does that actually mean for their bank account? Well, that difference in interest rates adds up to this. Over the 5 years of the car loan, person A will pay an extra $7,200 for the exact same car. Just think about that. That's a lot of money. And this isn't just for cars. That same score difference means higher rates on mortgages, higher premiums for insurance, bigger security deposits for apartments. A lower score is like a constant tax on your life. This isn't just a grade. It's real hard-earned money. Okay, this might all seem a little intimidating, but here is the really good news. You can build your score. You absolutely can. Even if you're starting from scratch with no score at all, there is a clear path forward. So let's walk through a simple, step-by-step plan to get you from 0 to a great score. First things first, you need to get some credit so you can prove you can handle it. A great place to start is a secured credit card, where you give the bank a small deposit. Or you could ask a family member with great credit to add you to their card as an authorized user. Step 2. Use that card for small things like gas or groceries, and always pay the bill in full and on time every month. 3. Remember that glass of water? Keep your balance super low. 4. Set up automatic payments. That way you never ever miss one. 5. Check your credit report for free once a year to make sure there are no mistakes on it. And finally, number 6. Be patient. This takes time. It's a marathon, not a sprint, but it absolutely works. Now, just as important as knowing what to do is knowing what not to do. So a few key things to avoid. First, don't close your old credit cards, because that actually shortens your credit history. Second, don't co-sign a loan for someone unless you are 100% prepared to pay it all yourself, because if they miss a payment, it hurts your score too. If you're struggling, talk to your lenders instead of just ignoring the bills. And please, please don't fall for those scams promising a quick fix. There is no quick fix, only time and good habits. And that brings us to our final and honestly our most important section. After learning all of this, it can feel like the system is in control. But the opposite is true. Now that you understand the rules of the game, you are the one with all the power. This is the one thing I really want you to remember. It is so easy to feel like this number is something that just happens to you, but it's not. Your credit score is a direct result of your actions. It's just a reflection of the choices you make. So if you control your actions, you control your score. When you boil it all down, after all the percentages and the rules, building a great financial reputation comes down to just two incredibly simple habits. It's not rocket science. First, pay your bills when you say you will, and second, don't borrow more money than you can comfortably pay back. If you can make those two things the foundation of your financial life, your credit score is going to take care of itself.
So my question for you is this. Now that you know the rules of the game, what's the very first step you're going to take? Will it be checking your report for errors, setting up those automatic payments, or maybe applying for that first secured card? Understanding is the first step, but taking action is what really builds your future. Thanks for joining me for this explainer.